Let's start off with this auction.
Yes, sir.
The 3 year is kind of an odd duck when it comes to the bond market. What are your expectations for this auction? Do you think that there's strong demand, or could this possibly be the first auction where we may see signs of that quote-unquote sell America trade?
No. I think that all of them are going to go well. And I think there's a natural tendency for the street to just kind of push it down to get higher yields. But in reality, when you look at the long bond, look at where rates are now, these are buying opportunities right now.
All right. We were hitting on this earlier. We got this data point from Moody's. For every week of the government shutdown, it's 0.1% of GDP negatively, obviously. It hits GDP a bit. When does that, or when does it possibly impact bond investors? When do they react to the idea of this government shutdown, or do you think it happens at all?
I don't think it does. When you go back,
but why not?
Yeah, when you go back, first of all, when you go back in time, whether you look back to 1995, we've had about 5 shutdowns, and they average anywhere from 3 days to 30 days. And if you look, the market's never really moved. And here's why. Because anything that happens is borrowed from the future. In other words, it's just a temporary, and ultimately things will happen and it'll get back on course. So I think these are great headlines. I think being in the dark on economic numbers, all that's really doing is delaying the inevitable, which is the Fed has to cut rates more.
All right, you're really focused on the spreads when it comes to corporate bonds. You're saying they're historically tight right now.
Yes, sir.
But I think there's a difference. They're not a monolith. When we're talking about corporate bonds from an Amazon, a Microsoft, are those top tier? Are those worth that tight spread right now? Or do you still see some questions about the investability of those as well?
So, well, the reality is corporate bonds are so narrow. And remember, the narrow spread means high price, that you're almost guaranteed to lose.
Which makes them less investable.
That's right. Okay. Which really means you're going to more than likely lose money, especially over the next year, whether it's high quality or whether it's low quality. And so if you're going to be in the corporate bond market, you want to be in the highest quality of all, because that will maintain its value. But in reality, I think you're going to lose money, and there are better places to be in the bond market.
Which is mortgage-backed securities.
Mortgage-backed securities, or even treasuries, but let's keep going.
Okay, why mortgage-backed securities?
Okay, because during COVID, we created some very interesting low-coupon mortgages. For the first time, we had mortgage rates at 2%, 2.5%, and now those bonds that were created are at such low dollar prices. Many of them are like at $80 price. When you get prepayments, whether it's people moving around, losing their job, divorce, bankruptcy, just life events, you get par back. So for the first time, mortgages are experiencing either no negative convexity or positive convexity. It's never happened before. It's just because of where we've been, which low coupons in an environment now that rates have come back up.
So you clearly, you don't have any concerns about the economy. You say the shutdown is pretty much a non-event in your mind, right?
That's correct.
Okay. So why isn't this the time for high yield? The economy is very strong. It's been boosted by AI and CapEx spending through AI. We get a new announcement for like billions of dollars every day. Why wouldn't this be the time for high yield? Because you also think we're going to get a series of rate cuts.
Yeah, here's the reason why. Because in reality, I am concerned, and I'm concerned about the economy as a whole. Because
whoa, you just said you weren't concerned.
No, that's where I'm going. If you look right now, whether it is housing, whether it is commercial real estate, whether it is wage growth, whether it is employment, all of those things are rolling over and are suggesting things are going to slow down. In other words, the Fed is not cutting rates because they want to have some sort of insurance. They're cutting rates, or soon they will show. They're cutting the rates because the economy needs to cut rates. That's why.
All right, so what part of the economy is strong? You named a whole bunch of parts of the economy, wage growth,
yep,
and a bunch of other areas that you see is rolling over. Then where's the strength coming from that makes you not worried?
Well, I think the key is, if you look, the stock market's been strong, but I think it's all an illusion. I think soon enough we're going to hit a place where people are going to wake up and say, you know what, we've been racing for all this AI investment, and how are we going to make money on it? And the answer is we're not, or not going to make as much. Okay. And that's when things are going to turn.